Good morning, everyone. Thank you for joining us here. On behalf of our JLO Canada and Southwestern Ontario team, we truly appreciate everyone taking time out of their busy schedules to spend time and go over what we're seeing in the commercial real estate and capital markets here in Southwestern Ontario and further abroad. Our objective today is pretty straightforward. We want to provide you with clear, data-driven insights into the industrial and office landscapes here in Southwestern Ontario, while placing it in the broader national and international capital markets context. We'll examine some of the forces shaping today's market and environment, from leasing trends and vacancy shifts to capital flows and investor sentiment, and most importantly, what those trends mean for your strategy in 2026 and beyond. I'm joined today by an exceptional group of colleagues. Mr. Scott Figler, our head of Canadian Research and Capital Markets Research here at JLO Canada, and Mr. Chris Kotzeff, who specializes in office leasing and capital markets here in Southwestern Ontario. Together, our goal is to deliver practical, actionable intelligence, not just commentary, so you can leave this session with clarity and confidence in your decision making. To begin, I'm going to hand it over to Scott Figler to lead us through the national economic backdrop and key research insights shaping today's market conditions. Scott, the floor is yours.
Thanks, Mitch. Thanks, Chris. Good to see you guys again. And thanks to our audience for joining. Appreciate everyone taking time out of their day for this. So it's been an interesting start to the year. It's been an interesting last year for us in the economy and the markets. I think across the board, we're seeing really kind of an inflection point, which we'll get into, but definitely interesting times. We're going to run through a presentation that includes a bit of an economic overview to sort of set the stage on what's going on. We're going to go into capital markets. We're going to do a deep dive on the office market and the industrial market, and we're going to try to do it all in an hour. So here we go. I'm going to start off just on a broad note about the economy and where we are and where the momentum is. So if you look at this chart, this is just monthly year-over-year GDP growth. So just showing kind of the momentum of the Canadian economy over the last 2-3 years. And if you remember, if you think back to where we were a year ago, before all the tariff stuff, there was a lot of optimism. There was a lot of exuberance. You see GDP growth gaining momentum throughout 2024 into the holiday season. And then what happened in January 2025, we started to hear about tariffs, and those plans started to crystallize. And then you just see that momentum kind of falling off a cliff. Now, what's good about this is that the Canadian economy has technically avoided a recession, but only barely. So it's not great, but I think we can look back at the last year and say that the Canadian economy exceeded expectations based on where we thought we were going to be, and a lot of the kind of doomsday scenarios about what this would mean for manufacturing and what this would mean for the economy at large. Now it's a bit of a nuanced story depending on where we're looking in Canada. If we look at how different economies are performing on a provincial level, it's clear that the outperformance is in the prairies, Alberta and Saskatchewan. So if you just think about like where the world is right now, where geopolitics is, it's all about extractives, oil and gas, commodities, agriculture, critical minerals. That is Alberta and Saskatchewan. So it's not surprising to see them outperform. If you look at Ontario and Quebec, these are more of the manufacturing hubs in Canada. So we see that kind of softening of the economy in those central and eastern provinces. And then looking forward to 2026, we expect Alberta and Saskatchewan to continue outperforming. Now, again, thinking back a year ago, I think what a lot of us sort of expected was that Southwestern Ontario, being the manufacturing epicenter of Canada, was going to be disproportionately impacted by tariffs. I think to a certain extent that has held true, but I think it's been more of a nuanced story than what we imagined going into it, keeping in mind the caveat that the free trade agreement renegotiation is happening later this year, and that really is kind of the main event with respect to trade. But if you look at this map, this is sort of a heat map showing, I would say it's sort of a proxy for exposure to trade with the US. Okay. And you can see that it gets brighter red in southwestern Ontario. So towns like Woodstock, Brantford, really those local economies are very strongly tied to trade with the US. And then on the right, this is kind of a ranking of all sort of middle and major Canadian economies and where they stack up in terms of that dependence on trade with the US. The towns that are most dependent are Windsor, Guelph, Drummondville in Quebec, and Waterloo region. So I think, I remember presenting this slide last year, and I think a lot of us were sort of expecting the impact to be disproportionately felt in that region. What's interesting is that now having a year of kind of perspective on this and looking at the numbers and seeing how different economies have played out, it hasn't exactly borne out the way that we thought it would. So if you look at Waterloo region, sort of what I would call kind of the capital or the headquarters of southwestern Ontario, you can clearly see the first half of 2025, there's a deceleration in job growth. These bars are showing year over year growth and employment. So year over year job growth. You clearly see the first half of the year, a deceleration in employment growth in Waterloo region, but then the second half of the year, it picks up. So that's really an interesting story. Meanwhile, I think if you look across Canada, you see a clear trend of economies slowing down, job growth slowing down over the course of the year. Two things that really surprised me. The first thing is that Edmonton is red hot. It's the only city in Canada where job growth has continued to accelerate over the course of 2025. The other one is if you look at Ottawa on the other end of the spectrum, we're starting to hear in the news about cuts to the public sector, Carney trying to sort of right size the public sector workforce after years of expansion. What's not as well known is that this has sort of already been happening, and it's starting to be publicized. But if you look at the data on job growth, Ottawa has been losing jobs at a rapid pace, going back to last summer. So that's been an interesting dynamic. Mitch, I want to pick on you for a second. What's the vibe like locally? I mean, this trend line in Waterloo region I found super interesting. Like, can you walk us through the local perspective moving through 2025 and how the economy felt?
Yeah, no doubt. When the tariffs were first announced, we saw a lot of pausing, if you will. A lot of worst case scenario thinking and planning, I would argue. Back half of 25, we saw a real pickup in deal activity, leasing activity, both office, industrial, which I do think is a bit of a leading indicator for intentions around employment. Now, it was very, secular in who's doing that leasing, who's doing that hiring. To your point about Ottawa, Scott, right? The public sector was not as active as some of the others. But no doubt some industries, food was quite active. Even right now, and this is a bit forward looking, you're starting to see more activity around holding inventories in Canada and Ontario as kind of a tariff optimization strategy before it may go into the US. The other thing that we're seeing is some of the defense spending that's intended to be, kind of deployed. You're starting to see movement of groups looking at that as well. So we're feeling very, optimistic. Now, obviously, there were some pretty dark times there in the first half of 2025, but you're seeing a nice little rebound. And we believe that once you get past the USMCA or CUSMA negotiations, kind of like interest rates, kind of like COVID lockdowns with case numbers, once everyone has visibility on what those tariffs are, then we're going to see a real acceleration, because we see a number of companies, tenants sitting on the sidelines still, waiting to get visibility on what that looks like and ready to mobilize. So, I hope that gives some overview.
Sorry, I put myself on mute so that you couldn't hear all the noise chatter in the office here. But um, that's a good point, and something to stress when we talk about how the economy performed in 2025. The slowdown that we saw, and I'll go back to this to show this slowdown. It wasn't really like mass layoffs happening in Canada. It was really, if you look at GDP and if you look at what was happening, if you read the Bank of Canada monetary policy reports, what was really happening was it was a sentiment recession, and it was a recession of business investment. So businesses were slowing down capital expenditures, which means also hiring, right? So it was a slowdown in new hires. It was a slowdown in purchasing equipment, a slowdown in capital expenditures. I mean, to make, you know, 30-40 million dollar investment decisions right now, you're more likely to just kind of wait a little bit till you have more clarity. So it's not like the sky is falling. It's that a lot of companies are just waiting for a bit more clarity before they hire, before they buy certain machinery or whatever. That said, the Canadian economy is changing, and it's interesting to see how, like, whatever happens with the free trade agreement, Canada is pivoting. If you follow what the Carney government is doing, they're very focused on diversifying their trade relationships and making the economy less dependent on trade with the US, regardless of the outcome this summer. So we're starting to get a sense of like what this is going to look like. Who are the trading partners? Who are the countries that Canada is starting to do more business with? You see, so this is a chart showing the year over year change in imports and exports with different countries. So you see this fall in the US. It looks small because these are percentage changes. This is actually a difference of about $25 billion in annual trade. So, but on a proportional level, it's, a loss of 2-3 percentage points year over year. But if you look at different countries, different trade partners that are kind of filling that gap, exports to China, we saw what happened a few months ago, the agreement with China to lower tariffs on Saskatchewan exports. That's huge for the Canadian economy. The EU is filling the gap. We're importing more from Mexico. We are exporting more to the UK. 54% year over year change in Canadian exports going to the UK. And then you see some other countries that haven't really played a huge role in the past starting to play a more outsized role. Brazil, India, Indonesia. So they're kind of important implications here when you think about port cities in Canada: Halifax, Vancouver. Where are goods moving to? For companies doing business outside of Canada, what markets are they increasingly looking to? This kind of gives you a good perspective on that. Looking at population growth, so we know that the government is cracking down on immigration. We know that we're kind of seeing the pendulum shift. This is showing the different economies that are being impacted by that. In Canada right now, demographic flows are being driven by affordability and cost of living. I remember doing this presentation with this audience a few years ago and talking about the outsized growth we were seeing in Waterloo region. That has slowed. So Waterloo region year over year is about 0.3% population growth, compared to, the 5 and 10 year annual averages, which are more around 3 to 4%, which was leading Canada. Toronto, basically flat on population growth year over year. So what's happening is that the type of immigration that has benefited Toronto, Vancouver, Waterloo, Montreal, specifically student visas and temporary visas, that is slowing down. We're starting to see more demographic flows being driven by interprovincial immigration. Where's that happening to? Atlantic Canada, the prairies, and some other kind of Toronto satellite cities. So Atlantic Canada, Moncton, fastest growing city in Canada. Halifax, top 7 consistently. The prairies, look at Regina, Edmonton, Saskatoon, Calgary, numbers 2, 3, 4, 5 in terms of fastest growing cities in Canada. And then again, those GTA satellite cities: Barrie, I would even throw Ottawa in there. There's a lot of movement from Toronto to Ottawa, and then St. Catharines in Niagara region. But it's not to say that we're not going to see a rebound in population growth in Kitchener-Waterloo. And this is why. This is data from Urbanation, which, if any of you are familiar, they're probably the best um, data provider or commentator on the residential market in Toronto. And they published a forecast showing housing deliveries in Toronto going through 2029. And we have more of a line of sight on this because we know what starts look like and we know what the construction pipeline looks like. And for condos, we know that it's drying up. So what that means is that as we head towards 2030, there's going to be a decreasing amount of housing delivered in the GTA. 70% of housing in the GTA is condos. So right now, condo construction is dead. It's completely dried up because the numbers don't work for condo investors, right? We know that. It's a well-publicized story. So what the implications for the market is that by 2029, that lack of condo construction means that in the GTA, there's going to be less housing delivered in that year than in any year in the last 30 years. So what that means for Waterloo region as a spillover market for the GTA is that we're going to start to see housing pressures in the GTA forming towards the end of the decade. It's going to create another wave of population spillover that's going to hit Waterloo region. So I'm going to go into capital markets, see what's going on on the investment side. So all things considered, last year, um, all the talk about tariffs, wild fluctuations in bond yields, cost of capital. After all that, 2025 was actually a pretty good year. It was only down about 3% versus 2024. A few highlights from 2025. Um, I feel like in every sort of presentation, I'm talking more and more about Edmonton. But if you look at Edmonton on a year-over-year basis, they're up 86% on sale volume. Waterloo region, not bad, only down 1.5%. Waterloo region actually, against the 5-year average going back to 2020, the 5-year annual average, Waterloo region is still up over 3%. That's actually Southwestern Ontario, so including Hamilton, Guelph, London. So just to clarify, that broader region is still seeing continued flows of investment driven by, some of these long-term structural trends, population growth, and so on and so forth. When we looked on a sector level, multifamily performed pretty strongly. The asset classes that were really penalized during COVID are starting to make a shift, starting to make a comeback. We're seeing capital rotating back into these sectors. Retail up almost 13% year over year. Office up almost 18%. Alternative assets, senior housing, data centers, student housing up 19%. The really big shift over the last year, I would say, is the slowdown in industrial and logistics, it's down almost 8%, and really land. Land is the big one. And if I go to this next slide, you can really see that drop off visually. The land sector peaked a few years ago at around, you call it 23, 24 billion a year in sales. That was around a third of the entire Canadian investment market. So if you go back to where we were in that year, housing shortages of industrial space, there was this huge kind of sense of urgency to build both housing and industrial. Developers were buying land and building. That's what was driving that. Where are we at today? We're seeing rental growth flat or negative in those sectors. So it's not an environment where developers are eager to buy a lot of land. So that fall off is really kind of responsible for the overall fall off in investment volumes. But if you go on a sector by sector basis, it's actually like not a bad story. And so as I said, multifamily is up, best year in 3 years. Office, best year in the last 3 years. Retail is doing pretty well. Alternative assets are on the rise. Hotels are improving. Industrial is down, but not significantly down from where it was a year ago. And if you look at pre-pandemic levels, industrial is still doing better than it was. So that's kind of what's going on in the overall capital flow space. But really, the I would say like an even bigger trend that we're following is the return of institutional capital. What do we mean by institutional capital? Foreign funds, REITs, pension funds, and investment fund managers, private equity. So all of those are in these different shades of blue. So you can see kind of their contribution to the market on a year over year basis. And if you look at this chart on the right, they're making up almost a third of investment volume. That's the highest percentage since 2020. And we know that privates have dominated the market. They're still, on a volume basis, privates are accounting for a higher share. But institutional investors are coming back. Why are they coming back? Because they see that fundamentals are going to improve over the next few years. They see a window of opportunity to take advantage of advantageous pricing on the buy side. So that's really the big shift that we're seeing. So I think another thing that's going on is when you think about cost of capital, um, you know, it, there's a I think there's a narrative that, we know the Bank of Canada has lowered interest rates, but it's not the interest rates that really impact acquisition financing. And this is something that we need to clarify that to make it clear for a lot of people across the market. So when the Bank of Canada lowers their interest rate, and you read about that in the Globe and Mail, that's this policy interest rate, this dark line here that has gone from 5% to 2.25 most recently. The prime benchmark, prime lending rate, it moves in lockstep with the policy rate. Prime is where variable interest mortgages are tied to, and also construction loans, in most cases, are benchmarked to prime. So the fact that that has fallen is helpful to a certain extent, but most commercial real estate lending is tied to bond yields. And the reason why we haven't seen volumes skyrocket or really kind of accelerate since these rate cuts is because if you look at where bond yields are at right now, they're really no different from where they were at back in 2024. Why is that? Bond investors are concerned about government deficits, and they're concerned about the inflation rate not going back to where it was. So the, for a long time, inflation was the target was really kind of, call it 2%. That was the Bank of Canada's mission, was to keep it as close to 2% as possible. That was in a pre-tariff world. The fact that we're seeing tariffs and we're seeing this decoupling from globalization, that is inherently inflationary. So bond investors are looking at what's going on in the world, and they are skeptical that central banks can keep inflation at 2%, and they are pricing in their bond investments accordingly. So that's leading to upward pressure on bond yields. So that's kind of the bad news. The good news, and I think this is why institutional investors are coming back into the market this year, is because I think that if you're holding out for cost of capital to go back to where it was in 2022, you're over that. You're moving on, and you're sort of internalizing where rates are at. It is what it is. You're not going to hold out for a few months thinking that there's going to be another Bank of Canada rate cut that's going to push down your cost of capital, right? So that's given, ironically, paradoxically, that's given some certainty to the market, and that's allowing institutional investors to move on and to just kind of approach the market how it is. And then if we look at office deal volume by market, what's interesting here is, like, we have seen a pickup over the last year, particularly the last 6 months. Most of that has been Vancouver. So actually, not most. Vancouver's been about 40% of office investment volumes. The Post, Pender Plaza, which our team was involved with, Oceanic Plaza, if you know that market, which again, JLL executed that process. Um, those were some of the biggest transactions in Canada, and it led to Vancouver really sort of driving office deal volume. Vancouver as the tightest office market really determines pricing for the rest of the country. If an A-class asset trades in Vancouver at a certain per square foot or a certain cap rate, that's going to radiate throughout the market, because then investors in Toronto or in Calgary and Montreal, they're going to look at the top assets in their market and they're going to say, okay, the Post traded at such and such, or Pender Plaza traded at such and such in Vancouver. What's the spread of Vancouver to Toronto or Vancouver to Montreal? So we're now seeing more capital flows because of those trades that happened in Vancouver. And then on the industrial side, it's a bit of a mixed bag. We've seen volumes slow in Vancouver, pick up in the prairies, uh, slow down in Toronto and in Montreal and in Ottawa. So it's really been kind of a Western Canada versus Eastern Canada story. Um, and then so this is something that we're talking about more and more in an environment where there's a lot of uncertainty. We're leaning more on real-time data within JLL, and we've developed this tool called the Bid Intensity Index. So basically, what this is we're collecting data on all the bidders um, anonymously. So if you're one of our bidders on this call, you don't have to worry; it's completely anonymous. We're just looking at, for each trade that we're working on, or for each sale, how many bidders and what's the variability. So what's the range of bids, right? And this gives us some insights into where the market is going. So if you look at office, for example, that this black line, this is kind of, think of this as the bid ask, the average bid ask spread. So for a long time, that bid would that there was just such a disconnect between the bid and the ask. We've seen that shrink to the point where it's basically close to zero. That means that there's more consensus, there's more convergence between the buyer and the seller. However, on office, we see a lot of variability, right, between the lowest bid and the highest bid. Contrast that with industrial, where, 2023, in that bull market, you saw the average bid coming in over asking, which is represented by that black line. You also see a smaller range, so less variability, more consensus on what pricing is. The other thing that I find interesting about this is that in multifamily, we see a growing bid-ask gap. So right now, the multifamily market is, there's a lot of supply. I wouldn't call it oversupplied, but we're seeing more supply, downward pressure on rents. So that's leading to a widening bid-ask spread between buyers and sellers. And then before I kind of go into these different sectors, I would conclude just thinking on an aggregate basis, I would conclude by saying that the biggest trend happening right now, it's not AI, it's not return to office, it's not any of that stuff. It's falling supply. This is the reason why we're seeing the office market stabilize. It's the reason why we're seeing the industrial market stabilize. I know in our business, we always want to talk about how people are coming back to the office, and it's true to a certain extent, varies market by market. But the fact that there's shrinking supply coming on means that the leasing momentum that we have is increasingly being funneled into, a smaller number of buildings, which is how it's gonna help the landlord side. It's gonna help the investment side. It's gonna create. It's gonna facilitate a return to rental growth, stronger returns over the next few years. This is, again, going back to that institutional investor story. That's why they're coming back, because they're foreseeing the impact of falling supply on the market. 2024, we had almost 50 million square feet of commercial space delivered. 2026, we're down to about 26, 27 million that's going to be delivered this year. And that's going to improve fundamentals across all these different asset classes. So industrial, you think about where we've been, we're using this sort of stoplight color coding system here, where green is, think about this from a landlord perspective. Green is really good. 21, 20, 2021 to 2023, we had very strong rental growth. Good time to be a landlord. 2024, 2025, getting more difficult. This year and next year, that's going to stabilize. And Mitch and I are going to get into more what's driving that. It's going to stabilize because there's less new supply. And then by the end of the decade, we expect that we're going to see a return to stronger rental growth, a return to lower vacancy. And then on the office side, I'm not going to go into every sector because I want to keep the presentation a bit focused here. On the office side, it's a bit fragmented. You really have to talk about the A and trophy markets, where the years after COVID, we really saw tenant favorable markets across the board. Downtown A and trophy are the first to inflect. They're the first to see a shift, and they're just going to increasingly become landlord favorable with basically no new supply. The downtown B and C markets are going to take more time to recover. The suburban markets, we see them stabilizing this year and then again becoming more landlord favorable towards the end of the decade. But again, there's a lot of things playing into that. I would say the biggest one is dwindling supply is the biggest factor. So I'm going to go into the office and industrial markets. So we're going to start with industrial. And I'm going to bring Mitch in here to help me talk about what's going on. So again, we've talked about this, the supply demand dynamic. We see the blue here is new supply. So you see this surge in new supply over the last few years. That is now starting to taper, and it's going to sort of stabilize. It's not going to fall off a cliff, but we're stabilizing around historical levels. But what's interesting about the industrial market is that we saw this tick up in demand towards the end of 2025, and that led to a stabilization of vacancy around 5.2%. And then if you look at what's going on in the new supply, you see there was a peak in the industrial market. The construction pipeline peaked over 50 million square feet of space back in 2023, and we're at about half of that. And it's probably going to keep diminishing and stabilizing at a much lower level. So again, this is really a tailwind to the market. It's giving developers, landlords, kind of the time to let their buildings fill up before the next wave of supply, right? And then just looking at the demand side, so I want to just kind of marinate on this a second, because a year ago we thought that the sky was falling on the industrial market, right? But looking back on 2025, this was actually the best year for industrial leasing since 2022. So Mitch, can you help us make sense of this?
Yeah, I think
what's
one
going on
really
there?
important thing to note is the lumpiness of these waves of deals, leasing deals in industrial. If you look at Q4 2025, Q3 of 2025, really robust, right? Made up about 2/3 of the annual volume. But you have these shocks to demand and decision making. We do appreciate that we're entering in the June of 26 CUSMA or USMCA renegotiation. We do believe that may cause a bit of slowdown in decision making and leasing for industrial. But again, we see on the other side of that, going into the back half of 26 in particular, probably a pretty strong rebound, regardless of what the tariff amount is. It's just as you get closer to elections or interest rates decisions or apparently trade negotiations, everyone just slows, but then rebounds. The thing that I think is really important for Southwest Ontario, Kitchener, Cambridge, London, is what's happening in Toronto. No different than housing. A recovery in Toronto will happen 6 to 12 months in advance. Rent growth happens in Toronto 6 to 12 months before it happens in, say, a place like Cambridge, Ontario. That's happening. And a market like Milton, Ontario, which held an incredibly high vacancy rate in the past 6 months here, has seen some real strong leasing momentum, which again, we think is really favorable going into the back half of 26 for rents, for industrial in a place like Guelph, Cambridge, anywhere on that periphery of GTA that has access. So we're encouraged by the leasing momentum for sure. And we see, to Scott's point about the diminishing construction levels, we're seeing the vacancy and availability chew away. Most of the deal activity right now is warehousing. Everybody remembers COVID, I'm sure. We saw a lot of supply chains get reshuffled. The third-party logistics companies, warehousings, inventories, those are what are making up most of the deal volume in leasing right now. We do see the manufacturing sector at some point, once we settle, becoming more active, but no doubt it's easier to move a warehouse than it is a production plant. And Scott's got on the screen here, you can see this is not just a local phenomenon. This is happening across the board. So, Scott, back to you.
Yeah, I mean, so you're talking about supply chains, 3PLs. I mean, if you think about what's going on in the world, all the craziness around supply chains, wouldn't you love to have someone manage your supply chain who knew how to navigate all that, right? So it makes a lot of sense that the 3PLs are a big source of demand. I would also just note that so this is kind of, going back to the economy, GDP growth, but this is looking at different sectors of the economy. Uh, this brown line here represents transportation and warehousing. And then this light blue represents just generally all services, retail, uh, consumer goods. So the, there's a more kind of structural thing to Mitch's point about uh, the difference between manufacturing and goods movement. There's a real structural shift happening in the Canadian economy where it's becoming less dependent on manufacturing and more dependent on the movement of goods. So that's another reason why, going back here, this seemingly paradoxical spike in leasing in a year where there's so much trade uncertainty, it's because of that shift in the economy and what's driving it. So the story's playing out differently across Canada. We can't speak it. Canada's a massive country. You can't speak about it as one market, right? So if you look kind of coast to coast, using vacancy rates as a gauge, a rough gauge of where we're at, uh, Vancouver, so the markets that really saw a huge uptick in supply were Vancouver, Southwestern Ontario, Toronto, and Montreal. Those are the markets that really saw that big shift. That's why we saw the kind of the shift of the pendulum in those cities where in a span of about 2 years, they quickly became oversupplied. Uh, but we're starting to see that come back a little bit and kind of come back into balance. So Vancouver had vacancy rate go up to 4.3%. But if you look at just the year over year change, you can just sort of tell that that's starting to slow down. So we're actually expecting vacancy to peak, probably in the next 2 quarters in Vancouver. Southwestern Ontario and Montreal, the two Canadian markets that are most tied to trade in manufacturing, even if it's, lesser not as much driven by that as by goods movement, still heavy manufacturing bases. So, those are the two markets that are where we see the highest vacancy right now. But to Mitch's point, in Toronto, this is another market that we are starting to see signs of an inflection happening this year. Rental growth has started to actually trend up in certain pockets of the GTA North. So Vaughan, Richmond Hill, Brampton, rents are starting to pick back up. And because places like Milton compete with that, that's going to have a spillover effect, and I think over the next year, we're going to start to see Southwestern Ontario, certain pockets, certainly I would bet on Guelph, whether it spreads to like a Woodstock or a Brantford. I think those might be, they might take a bit longer, but I think the submarkets that are closer to the GTA might be quicker to inflect. But then the other takeaway here is Alberta, Calgary and Edmonton have the lowest vacancy rates in Canada, very strong industrial demand in those markets right now. Calgary is pulling a lot of demand from Vancouver because tenants are getting priced out of Vancouver. So these are, on the investment side, definitely markets to watch. And then, Mitch, to your point about where rents are, so here we see Southwestern Ontario, kind of peaking almost $15 a foot, now down to about 13.35. Vancouver rents are still falling. Montreal, they're still falling. in the prairies, rents are ticking up, and I think they'll Calgary especially is probably going to see a big uptick this year. Um, Mitch, uh, do you agree with my assessment about certain submarkets in Southwest Ontario, like a Milton versus I'm sorry, a Guelph versus a Woodstock or a London on the other side? Like, do you think it's going to follow that kind of path?
Yeah, we're already starting to see that. We saw it, at other times where there's this, seeking affordability, if you will, right? There was seeking availability in the peak of COVID when we were at 1% vacancy rate. Now it seems like the recession playbook for a lot of operating companies is where can I be accessible, have good access to labor, transportation routes, and access to GTA. And as long as, markets like Cambridge and Guelph, in Brantford in particular, are relatively well priced compared to Toronto, they're going to perform well. As an example, Brantford, Ontario is holding about a 2.5% vacancy rate. Why? Because it didn't see a big run up on spec development, and it's $12 rents, net rents for a brand new space. Compare that to GTA pricing, even in Hamilton where you were 15, or Cambridge where you're $15 a square foot. Brantford was the first to absorb because it was accessible and had a lot of value relative to GTA. So no doubt, Scott, we see that carrying forward.
Mitch, there's another question. I'm going to keep picking on you. On the investment side, one of the biggest trends that's jumped out to us is user purchases on the industrial side. So, I mean, this is something, Chris, this is something that we saw in office like over the last 2, 3 years, especially in your market. Um, but really, kind of over the last year, the user acquisitions have almost like doubled down on the industrial side, even as they kind of slowed down on office. So, Mitch, 21% of market liquidity is driven by, not pension funds, not private equity, but users buying buildings. Can you tell us what's behind that?
Yeah, I think it's important to look at the scale of those user acquisitions. Number one, it's
Okay.
math driven, right? You do the calculation on the impact to cash flow for owning a property, what your mortgage payment versus what your net rent payment may be. I think we saw some real good activity in the owner occupier or user space there in the mid 2025. I would say Q1 2026, we're seeing a bit of caution on some of the user acquisitions simply because they don't want to deploy that capital. It's cash
Right.
preservation in some cases. We do think, though, back half of
Interesting.
26, that user owner occupier activity picks up again once there's trade understanding, because math doesn't lie. The cost to own a building, an industrial building, the mortgage payment is about the same as market net rent for simplicity. So if you have either cash to pay for a down payment, or you have a vehicle like the Business Development Bank of Canada, who may give you 100% loan to value financing, we think that drives more of that owner occupier activity. But I think it's important to note where the sweet spot is for users in a market like Cambridge or Kitchener. We're not seeing a lot of 200,000 square foot owner occupier
Yeah.
purchases. These are more of your 30,000 square
Yeah.
feet, 20,000 square feet sweet spot owner occupier buys.
We actually dug into this a bit more, and that totally. So I can actually give you being the research guy, I can give you a stat on that. 80% of user acquisitions are for um, buildings 50 square feet and less. So to exactly to your point, it's the small bay market that's being targeted for this. It just stops making sense for on the large bay segment, but and that's interesting what you said about cash preservation. So it makes me think that like maybe in markets where there's more um, trade relation with the U.S. So maybe we continue to see more user acquisitions in places like Calgary, Edmonton that aren't as affected. Vancouver, obviously, condos is a big part of the Vancouver market. Maybe markets like Calgary, I'm sorry, Southwestern Ontario, Montreal, that might be slowing down. But again, after more certainty, after the trade agreement negotiations complete this summer, we might see a doubling down of that trend. Okay, so I'm gonna shift to the office market. talk a little bit about what's going on there. There's a lot of exuberance, a lot of excitement, a lot of optimism, um, and we'll talk about what's behind that. So, to my earlier point, um, this is, there's a story here about return to office, which we'll get into. There's a story about organic, just natural headcount of companies. There's also a story about lack of new supply. So if you look at these beige bars here, this is new office completions of every year. In Canada, averages about 3.5, 4 million a year, 3.5 more 4 million feet a year of office space completed going back 15 years. If you look at what's going to happen this year, going ahead to 2029, um, over this period here, there's almost no new office construction. I mean, and even this is a new development that was announced that broke ground in Ottawa. If any of you heard about this, is the Nokia R&D space that we're not even sure this is going to be speculative. This might be all Nokia, but they might end up subleasing or leasing a part of it. But really, it's almost no new supply coming in the office market. So this is what's happening is that all the demand out there is not being spread out amongst new construction versus existing. It's just being channeled into the existing market, right? So that's why we see availability rates falling now down to about 16.6%. Vacancy rates, sort of trails availability. We track both. Vacancy is more based on occupancy. So the reason for this gap is that um, new construction that pre-leases, that hits our availability rate, pushes it down. But we wait until those buildings occupy and become operational before it hits our vacancy rate. So this is specific to CIBC Square in Toronto, where it's going to be operational kind of any day now. When it is, that hits our absorption and it hits our vacancy. So for those of you who are wondering why we still have negative absorption for 2025, that's why, because we don't count absorption until the building is operational. Otherwise, we would have had positive absorption. But then looking ahead to 2026, just CIBC Square is about 1.5 million feet of positive absorption that's going to happen. And then you combine that with the leasing momentum, we could be in for a year of around 3 million square feet of positive absorption in the office market in 2026. So if you look at leasing volumes across the country, there's something else interesting that's happening here. So, we always kind of make these comparisons to 2019 as the pre-pandemic benchmark. Well, office leasing volumes are actually at their highest level since 2018. So these bubbles here are showing the annual quarterly average of leasing volume. So 2025, we have just over 7 million feet of office space leased per quarter. That's the highest of any year going back to 2018. 2018, we had almost 8 million feet per quarter. Right. So there's a lot of momentum there. And I think this gets at, I think there's a lot of talk about return to office. I myself am, I think it's more driven by other factors, not to say that return to office isn't happening, but this points at something else to me, which is that this period here, the late 2010s, you had a lot of leases being signed. Typical office lease is 5, 7, 10 years. So that puts you out here to this 2023, 2024 period. But remember, we had a lot of tenants who were trying to figure out what was going on after COVID, hybrid, remote, in office. So a lot of tenants extended their lease another year or two, kicked the can down the road. That has led to a spike in leasing volumes in 2025, where it's a combination of tenants needing to expand, tenants needing to make decisions because they're at their expiry. Chris, I want to get your feedback on this. Like, do you see the leasing momentum in your market as mostly expiry driven, or is it driven by return to office and a need to expand? What's the driving force? I know it's hard to generalize, but if you could tell us a bit about what you're seeing.
Yeah, for sure. I would say like it's a mixed bag of everything, Scott. And I think you kind of answered this question already because we're seeing the same things here in KW. Like it's partially true. It is expiries and lease expiries and deals done sort of late 2010s. A lot of tenants were kicking their, decision making down the road by 1 or 2 years during COVID times. And then honestly, they did it again, for another 1 to 2 years to sort of catch up and make plans and figure out what's what. Um, so yeah, right now I would say it's a combination of, exactly like you said, you've got lease expiries, companies that are putting a big, big, big push on getting people back into the office, getting teams back together. That's driving decisions. And, some of it is we're staying in place and we're figuring out what that means from a square footage perspective. Some of it is growth stories. We are seeing some of that for the first time in, probably 5 years, which is great. And it's, a lot of thinking around what can we do to bring folks back, give them the workspace they need, and really align what's going on in the world of office right now. So, just as a general note, that 1 to 2 year sort of lease renewal thing that we saw a lot of over the last 5 years is now looking a lot more like 5 to 10 year terms. I mean, 2 year, 3 year deals are still happening here and there, but even on the, the bigger corporate renewal stuff that we work on, you're seeing a lot more 5 year, longer term leases again. So I probably just repeated, Scott, a lot of what you just said, but it really is a good summary of what we're seeing right now.
And then, so the other big trend is, we hear a lot about this flight to quality. So again, as the new supply tap shuts off, demand demand is funneled into the existing market, and tenants were going to kind of trophy assets first. So we start to see this beige line of trophy availability start to fall beginning in 2023. That's when it peaked. And what's happening now is we're starting to see, as those buildings fill up, we're starting to see kind of the next tier of assets starting to fill up. So that would be this blue line Class A, which you can see it kind of peaked in 2024, now is starting to fall. And then, so the green and purple represent Class B and Class C. Not clear. Like I think we're still going to see some. Those are clearly going to lag, especially in Toronto, where I am. The Class B market had significant negative absorption. So, I it's hard to say whether that's going to change. I think we may just be at a structural point in the market where buildings where there's not much investment, maybe they do see a bit of leasing volume flow, but I don't see that vacancy rate or that availability rate really materially falling from that point. But I do see the Class A availability rate continuing to fall, maybe a few basis points over the course of this year. Another kind of signal that we're seeing in the market is subleasing and what's happening there. So subleasing, this chart on the left is showing sublease availability just falling over time, which is, I think we've all heard about that. But the problem when you talk about subleasing is that it's not really a positive signal for the market if it's happening because, like, let's say the term expires on the head lease, and instead of just being categorized as sublease, it's a direct vacancy now, right? That's not really a positive signal for the market necessarily if sublease availability is falling. So what we did is we did an analysis on new sublease listings added to the market. And this is critical because it's really a proxy for how many companies are trying to shed space. And that is clearly falling over time. Chris, I know that we saw a pickup in subleasing in Southwestern Ontario. Are you seeing that? Is this consistent with what you're seeing, like our tenants kind of reclaiming space more in your market?
Yeah, exactly. It's no different than what you're saying, Scott. Like, during COVID, it was used as a tool. No one's in the office. Let's see if anyone's out there to take the space, get this off our books. Period of time you can save money. As that story played out, I think one of the important things there were a lot of companies were thinking subleasing space was going to actually save them a bunch of money. And then, moving to a smaller space would be the program. But once they got into it and sort of evaluate the cost of moving, doing a build out. It turned out to be more expensive to actually do that. So you saw a lot of companies just maintain what they had. And now with the return to work and the pushback, I would say it's just, they're actually using the physical space now. So I would say it rings true. Like, unless there's a very specific purpose, like, hey, we're out of space and we're midterm and we need to dispose of this space. Or, there are still the odd, companies, especially in the tech space, that are still holding on to this. We're never going back. Type of thinking. You're not seeing it as much, but those would be the only couple reasons, I think, very specific purpose for doing it.
Thanks, Chris. Another positive signal that we're seeing in the market is a return in VC funding. I know in a market like Waterloo, Kitchener, there's a lot of smaller startup companies that are relying on VC funding, which really kind of dried up in 2023. We're seeing that bounce back. 2025 was actually the best year for VC funding since 2022. So that's a positive sign. But it's important to note that the story isn't playing out equally across Canada. So again, I would point to the Prairies, Vancouver, Calgary, Edmonton, Winnipeg, where we've really seen a consistent fall in office availability rates. Eastern Canada, it's a bit more of a mixed bag. Southwestern Ontario, we've seen availability rates kind of stabilizing around 15-16%. Montreal and Ottawa really are, I would say they're the two markets where we're still seeing office availability increasing. And I don't really see that kind of peaking for, another few quarters. But definitely Toronto, we've seen the peak. And again, we're seeing that demand radiate out throughout the Toronto market. Just a few more minutes left, so I'm gonna just kind of try to touch on a few more things quickly. But Chris, this is something I'd like to get your thoughts on just before we conclude. This is a chart showing office vacancy by what we call clusters. So downtown, urban. So this would be in your market. This would be like uptown, Waterloo, not quite downtown, not quite suburban, and then suburban. So across Canada, downtown office vacancy is higher than suburban across the board. In Waterloo region, downtown, which I would really call downtown Kitchener, the downtown of the region, it has one of the highest downtown office vacancy rates in the country. So I know there's some nuance there, but can you talk a bit about what's going on there?
Yeah, so to your point, there is a lot of nuance there. I think it's really important for, everyone to understand that, while we show downtown Kitchener or Waterloo region, urban or whatever as the sort of, one of the highest we're tracking in the countries, it's also one of the smaller markets, right? So Kitchener, in the grand scheme of things, pretty small market compared to the others. Using downtown Kitchener or relating it to that specifically, because we hear a lot about downtown Kitchener having a north of 30% vacancy rate. We kind of went through the stats to sort of look at, is this actually true? What does it look like if you pull a couple of these buildings that we know are slated for development? So there's 3 really large buildings downtown Kitchener that are completely vacant. And, arguably, if you took these landlords and offered a lease, hey, here's a deal, they wouldn't react to it. Their plan is to maintain vacancy and, look at what the future use of these buildings are. And, between the 3 buildings, there's about 750,000 square feet of space, which is massive. So in a small market like ours, that has a big impact on vacancy. So if you strip those out, it puts the downtown Kitchener vacancy rate, closer to that 20%, which, obviously is still significant, but it's a lot better than 30%. So you really do need to drill into this stuff to sort of understand what's going on.
Yeah. Good point. So we are at about 10 o'clock. I do have just 2 more slides. Can we go 5 minutes over, just a few minutes over? Are we good to, okay. Because I think this is an important thing to discuss. So there's a lot of talk, stock markets, what's happening lately. we have these kind of investor fears about AI rippling through the economy. We've seen real estate stocks get hit. By the way, great time to buy the dip on JLL. Um, but what's behind this? So there's a study that came out of last year out of Harvard showing that back in 2023 when ChatGPT launched, starting at that point, there was this slowdown in companies hiring junior employees, companies that were adopting AI, slowing down their hiring of junior level employees. So you see this employment job growth for junior staff versus AI adopting companies versus non-AI adopting companies. And you see that bifurcation. Companies that are adopting AI are really kind of slowing hiring of new employment. And then within those companies that are heavily adopting AI, you see employment growth for senior level positions continuing at the same pace. Well, it's not that they're shedding a lot of junior employees, it's just that it's kind of flatlining. So they're basically not hiring. They're not laying off, but they're just kind of slowing hiring. This is a little noisy because it also coincides with the rising interest rates that we saw in 2023. And right now, with so much uncertainty, we talked about this at the beginning of the call. What's driving the slowdown in the Canadian economy is not widespread layoffs. It's a recession of business certainty and conviction until we get through, whatever we're going through, right? But it's things like this that are kind of making headlines in the office market. So it's something to be aware of for sure. Like, I think this could be a trend to watch in the office market. Like, how does AI impact space utilization for tech companies, insurance, law, some of these other knowledge sectors? But we kind of dug into the numbers because I wanted to know if this was impacting companies in Canada, and the resounding evidence is that it's not. So I think this study might be more related to the US, because if you look at what's been happening in Canada, this is job growth going back to 2022. So for the economy, on the scale of the economy, employment has grown at about 7.3% over the last 3-4 years in Canada. But for office using sectors, so this is finance, insurance, tech, software development, all that stuff, you've seen a 12.2% employment growth. So now we know that, and Chris, you're there's like a ratio common in office leasing of how many employees per square foot, which that is constantly changing. It's been in flux for decades. That's not a new thing. And it's clear that hiring 100 people means less square footage than maybe it did in 2015. But there's still a lot of headcount growth. And this is the point I was making at the beginning of the office section. Yes, there's return to office. It's happening, playing out differently in different markets. But there's the lack of supply, but also there's real organic headcount growth happening in companies. And this is a huge driver of office demand right now. Even if, we're still seeing companies leverage a hybrid model, maybe certain components of their business continue to operate remotely. That might be the world we're living in, but what's clear is that just the volume of headcount has grown, right? And this is a tailwind to demand, and it's showing that this shift to AI isn't really impacting office using companies. They're continuing to hire, they're continuing to grow, especially in Waterloo, which is this beige line that you see, 34% increase in office using employment growth over the last 3 years. So I thought I'd end on that, kind of addressing the elephant in the room, but also providing, some data-driven evidence to sort of inform that narrative. So I'm going to end it there. I want to thank everyone for listening to me, and I'm going to Mitch, Chris, do you guys want to close it out by saying anything to the audience?
Yeah, thanks, Scott, and thanks, Chris, for all of your insights, guys. Thanks to all the participants. I know we went a couple minutes beyond for hopping on and taking part this morning. The market continues to evolve, and while volatility can create a lot of questions, it can also create a lot of opportunities. The question is where we're at in any given cycle. I mean, it wasn't that long ago that everyone thought office was dead. We've heard the comments about retail being dead. Two asset classes, as Scott's shown, have really shown some real robust recovery here. We do think industrial follows a similar fate as we get past trade negotiations. But our commitment to the group here is to be a strategic resource to everyone. We have a heck of a lot of data, always happy to pressure test any assumptions or underwriting. And if you'd ever like to continue the conversation, feel free to reach out and we can explore further in depth. But want to really thank everyone for jumping on today's call. Thank you, Scott. Thank you, Chris. And we'll be sure to be in touch soon.
Thanks everyone. Appreciate it.